giving you any type of specific investing advice. So why would we have a pre-market planning session? It should be pretty self-explanatory, but for the most part, we have them listed out right here. We want to find, we want to have, or we want to develop, I think is probably the better word. We want to develop a set of conditions to trade within during the trading day. So I'm sure a lot of you, if you've been in this industry for even a short while, you guys know you look at the charts before the market opens, everything kind of makes sense, or at least it might have some good ideas. And then the market opens and you get this increase in volatility and volume, and the market starts moving all over the place. And the next thing you know, you're doing something that you didn't originally plan to do, and you're getting lost inside of all the movement. Rather than doing something like that, it makes a lot more sense. You're going to have better results. You're going to have kind of a consistent plan that you follow every morning. It's going to make this a much easier thing to navigate, right? So we want to have conditions for our trading to trade within. We want to find trouble zones for the bulls and the bears. So strong support and resistance levels in the market that we can hang our hats on as places where we would expect there to be rotations and be great places to look for trade opportunities. And then finally, I always like to establish some type of high time frame context and high time frame signals that might help bolster a certain bias or direction that we have for the market. So how do we do it, or how do we do it here at the S&P 500 Roadmap? First and foremost, this is what we talk about every morning. Make sure we have the times of announced news events mapped out on our short time frame charts, right? So that's another thing. You get the market opens, it starts moving, you start getting excited, and then all of a sudden you go to get into a trade, and then bam, the whole volatility spikes. The market jumps 20 minutes up, 20 minutes, 20 points up, 50 points down, 100 points up. And you're like, what the heck just happened? Make sure you know that these big notable news events are coming up, and make sure you have them on your chart. So what I usually do, and I don't know if I can bring this over on top. Yeah, I can, is I'll go right onto my tick chart, right onto my 1 minute, right onto my 3 minute, and I'll actually put a horizontal line right at the time of an expected news event, right? And actually, we're going to go through all this, so I probably don't even have to share that right now. But first and foremost, get those times on your chart, right? That way, you know if you're about to enter a trade, whether or not you might have some jump in volatility, or if you're in the middle of a trade, maybe you should be careful, okay? And then what I do is, after I mark those news events on my short time frame charts, is I jump to the higher time frames. And you see here I put read and interpret what the daily and weekly candlesticks are saying. I also actually jump one more time frame above that, and I go up to the monthly as well. So the daily, the weekly, the monthly, and then even down on the 4 hour, just below the daily. I want to look at what the candlesticks are telling me to help me, again, build up this structure of what I want to do once the market opens. And we'll get into that. What I'd like to do is just share kind of the basics of how all this works, and then go to the actual live charts, and we can maybe do kind of a mock pre-market plan, kind of pretending like we are just about to open right now, just as the market's actually closing, right? So we will go ahead and go to the charts and do all this stuff so you can see it, not just on a theoretical list here. Then I want to ID and mark the most relevant high time frame where you see MTF is multiple time frame signals. So a lot of times we'll get a signal on, say, a daily chart, and that daily chart signal will end up turning into like a 250 point push on the S&P, right? Plenty of opportunity to make money. And this signal that might start to show up on the higher time frames is giving us clues that there is potential for a larger move in the market, right? So we'll take a look at that when we get to the charts as well. Then I like to map out the larger Fibonacci legs, right? So if we're looking at a zoomed out chart, there's going to be very obvious, at least if you've spent a little time analyzing with Fibonacci, you're going to find some very obvious Fibonacci legs that you can use to map out some of those retracement levels. And so that's another thing that I like to get on the charts before the market opens. And then I want to map out relevant levels, right? So once we get some context from the higher time frames, once we see what the monthly, the weekly, the daily candlesticks are telling us, maybe what some signals might be saying on those higher time frames, now I actually want to start to map out relevant levels in the market that could end up becoming contention for the bulls or the bears, depending on which direction price starts to move. And I typically stick to the 60-minute chart at that point. I am looking for major swings on a 60-minute chart, not on the daily or a monthly or a 10-minute chart. But the 60-minute chart is where I kind of stay. I anchor myself in between the high time frames and then the lower time frames, right? So we'll go and I'll show you how I do that as well. And this is kind of where we're going to find those little areas in the chart where we do have some good areas, and I got to watch my words here. You're going to find good areas where price could very well get a rotation and you could find a great trade entry, okay? And then finally, once all that's done and we're getting ready for the open, we'll jump down to those short time frame charts. For me, my short time frame charts are a 512 tick. I know some of you probably think I'm crazy. And then a 3-minute chart that I put right next to it. And that way I have kind of a little zoomed in view of my charts that I can then find trade entries on. So that's the basic gist of it. Now let's continue here. Once we have all those levels and signals mapped out, now we can kind of create a bias or a trade plan for the day, right? So based on what happens, remember, the market is fluid. It's always changing. New information is coming in, especially with the S&P 500. We have global news. We have local, national news, domestic news, all this stuff all affecting the movement in the market. We have relevant economic factors, all these different things. We have people speaking, whether, if you guys remember just a couple of years ago, the Trump era, when the market would just whip 100 points up and down all day. It was kind of a fun time to be trading, but also somewhat dangerous because out of nowhere, Trump would make a tweet and the whole market would get some crazy jump in volatility, and you just had no way to predict when that was going to happen, right? So it was kind of fun, I have to say. So we want to have a plan, right? We want to say, hey, look, if this level holds, maybe this is something that bolsters our bias for this type of direction, because it's always changing, right? We need to be able to adapt to these new conditions and trade accordingly when this new information is coming in, when the market is changing, and maybe it's doing something different than what you originally expected. So this means we need contingency plans for when things just aren't happening the way we expect, right? So we'll have a plan for what we might expect to happen, given maybe some type of signals that are showing up on higher time frames, and maybe some relevant levels that we've mapped out are actually holding. Those are things that are going to give us clues as to whether we want to follow one part of the plan or maybe just reject that whole thing because the market is showing new information and then start trying a different, right? So remember, trading is just if-then statements over and over. If this level holds, then we'll do this. If that level doesn't hold, then we should try this. Given the perspective we have from the higher time frames and then from what's happening on a shorter time frame based on levels. And that's it. That's my whole presentation, guys. No, so this is really just kind of the general idea. I know it's pretty straightforward, but I think sometimes people forget, right? They forget, they're excited for the open and they just don't spend the time to actually look at the charts and look at the clues, because the charts are going to give you clues as to very important areas in the chart.